Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yep, and it's Friday, Jim. It's always Friday when we talk. And there's some problems in the markets this week.
Well, a little bumpy, but we had CNN business news saying, at least on September 11th, an interesting date, that the bull market just won't die. Well, will it just live forever? Has it become a vampire?
Well, about that time, I was thinking about a line that I crafted a long time ago, back when the jokes about how many does it take to change a light bulb were going around. And that's when I came up with how many bulls does it take to change a light bulb? None. They never burn out. This is another line. Well, that headline also had, experts say the market could keep powering ahead. And of course, you always get very positive headlines. As, you know, a tremendous stock market surge is peaking. And there's more to it. The stock market always gets the media coverage in as it's happening, but the credit markets are much bigger than the stock market on a market cap basis, and they get bubbled as well. So it's not merely just measuring the technical degree of excess in the stock market. You also got to do the same in the credit markets, like, well, the one we've been focusing on has been the credit spreads, and they had accomplished in August the second breakout to widening, and the one we use is the CCC spread relative to treasuries, and that was the second breakout to widening is the clear-cut warning, and then things kind of go to hell when you get the third breakout on widening, and that happened yesterday. So that credit spreads are not friendly. And then the other one we've talked about, Jim, has been the yield curve, and that's the difference between long-dated and short-dated bonds. And it does a regular pattern as a bull market completes. But it's sort of vague. You can't use it for trading, but you know at some time it's going to reverse the steepening. And it looks like this week has made a step in that direction. So you now have both key aspects of the credit markets in saying negative things. And of course, within this, you've got the 3-month Treasury bill rate, which in going up was saying that the boom was on, and it reached its peak in March, and then it rolled over, and then by into May, the decline was distinctive enough in the bill yield that you say, hey, it's a trend change, which to us was saying that the best of the boom was in. And by boom, Jim, you sort of like everything goes in there. The boom in stocks, bonds, commodities, and everything. So, then plus the economy. Yeah. So the boom, the Treasury bill yield reaching a peak said that the best of the boom was in, and then in sharply declining said that likely the boom was over. So then the other thing we were watching through the year was that you had liquidity problems suddenly discovered in, first of all, lesser countries such as Argentina and Turkey. And this is a term that we've used for decades, that when you have a problem in the lesser exchange, it eventually feeds into the senior financial market, now New York. But then when India had a liquidity problem, and then when China had a liquidity problem, you can't say that those are lesser exchanges. They're just so huge. So then that's where adopted a term, outlying exchanges. So the rule is, with the updated phrase, that when you have a series of problems discovered in outlying exchanges, it'll inevitably hit the financial capital, which is New York. So going back a few weeks when the Fed suddenly moved to inject liquidity into the New York market with what they call repos, people thought that that was kind of mainly a policy move. But no, it was the first arrival of problems that, let's call it a financial contagion, that started earlier in the year with Argentina and Turkey. So one wants to be clear that the Fed moving to inject liquidity wasn't a policy determination. It was a reaction to the sudden disappearance of liquidity in New York. And that was just step one. So then now what's happened this week is that obviously there's been a lot of pressure on the stock markets. But as of yesterday, that pressure is now showing up in by the credit market. So what one can conclude is that this isn't just a correction in the stock market. It's the early stages of a severe contraction in all of the financial markets that will be accompanied by a recession. So for us now, the recession is built in. So then what we will be doing is watching the NBER, National Bureau of Economic Research, which is it's sort of a semi-formal body that does keep track of when a recession starts and when it ends. And so now they're often with that statement a year after the actual recession had started. So this is going to be interesting.
We'll have more with Bob Hoye right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Bob Hoye. Bob, the housing and workspace people who had initial public offerings recently have found out that the stock market can be a cruel place and pretty judgmental instantly. What's the story behind that?
Hey, Jim, you're good at writing headlines. Well, they had this huge fantasy market. They've been calling some of these new issues, or IPOs as they call them, initial public offerings, huge amounts of money raised on money-losing schemes. So they've been calling them unicorns. And along came this one, which is sort of Office Space, and very big, huge numbers on what the pricing was on their new issue. And then over the months, they kind of got a little more realistic and started dropping the price of the proposed issue. And then it sort of reminded me of in 1929, where in London there was a guy who was a terrific promoter, Clarence Hattree, and gosh, through the 1920s he had a number of deals, and some of them went bankrupt. They just failed and went bankrupt. But as some historian wrote, that he was always able to, despite the bankruptcies, he was always able to come out with money and live the grand style. And then had put together his final deal, and he was going to take over an important steel company in England. And early in 1929, he had his financing set up and promises this and that and the other thing. And then as the year went on, people who had said they'd help him got cold feet. By help him, I mean, provided the funding to do the takeover, and got cold feet and backed out. And then he knew that he was hooped. So he even had the nerve to get through to meet with the governor of the Bank of England and said, if I go down, the market will go down. And so give me some help, like bail me out. And the governor wisely said no. And, of course, when he failed, it was headlines, but he didn't cause the market to go down. He was just one of the casualties. And this, Jim, takes us back to the original founding of the Federal Reserve System, whereby New York bankers are, of course, always looking for some kind of way to prevent bad things from happening, and dreamt up the Federal Reserve, which was a polite way of, they couldn't call it a central bank because the U.S. had had two bad experiences with a central bank. So they called it the Federal Reserve System. Now, they really believed at the time that they knew that a financial setback preceded a recession. It's the way businesses worked for hundreds of years. But their theme was that with the Fed as the lender of last resort, they would prevent the financial setbacks that precede recessions. So then there would be no more recessions with the establishment of the Fed. And according to the NBER, there's been 18 recessions since the Fed started, or the act was passed in 1913. So it clearly, the system doesn't work. And it's my conclusion now that the next recession, number 19, has started already. So here again, but is another setback. Let's put it this way. The financial setback on now is severe enough that it's likely anticipating or signaling a recession. And another week or so of pressure in the financial markets, and people are going to give up. And it's methodical how these things work. And you can, as I said, we can cite examples in the 1929 bubble of Clarence Hattree in England. And then there was a wonderful one in 1873 in New York, which was it was then an important but outlying exchange, because London was the center of the financial world, and J.P. Morgan was the powerhouse in New York, and there was a new upstart broker underwriter by the name of Cook, and he became very influential during the 1860s in funding railroads and became an important player. And then in the 1873 bubble, as it was getting really exciting, he started running into trouble. And of course, being a new kid on the street, and he didn't have the contacts, and I guess the amount of business he was doing kind of bothered the senior guys. So when Cook and Company ran into trouble, they got stuck with some huge bond issue that they took down as by way of an underwriting, and then didn't have a selling syndicate to get rid of it, or the selling syndicate packed it in. But at any rate, the senior guys in New York knew that Cook was stuck, and they weren't going to help him. And Cook went under, and so did the whole market. But it wasn't that he caused it. He was just the big name at the time. And there you could probably find others on previous great bubbles. So there's nothing really new out there, Jim. And sad to say that the setbacks in the last few weeks are serious, and they're typical of about the same point in 1929 or 1873, and now it's gone far enough down that in the stock market there won't be a soft landing. Remember earlier in the year we talked about technical excesses on the upside, overboughts, upside exhaustions, from which we were getting sequential sells and stuff like that. So you had great excitement at various times during the topping process, and you'll have the equivalent excitement on the bottoming process. And fortunately, we've got an idea of when this washout could conclude. And we will also have the technical analysis of when the buying point is, because when you get a falling market, as the old saying is that if you're stepping in to buy something too early, it's like trying to catch a falling knife, and you don't want that. So we should be able to get both the timing on when to buy and also a measure on whether it's oversold enough to begin buying. So we're looking for that. In the meantime, it's still not too late to raise a little money.
We'll have more with Bob Hoye right after this.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, so many people have said gold could be a safe haven if the stock market does take a nosedive. Would it be? Could it be? And how would you make sure that it was?
Yeah, good one. Gold is really a financial instrument, and as a matter of fact, it's cash, it's money, and in a bubble, gold's real price goes down. Purchasing power diminishes, and the gold miners don't make so much money. And then as the financial bubble concludes, the gold's real price bottoms and then starts to go up. And this is happening where the real price came down and it spent a year and a half setting a base, and now it's turning up, and the chart is acting well. And that, by real, I mean you take the price of gold and deflate it by the CPI. And this is, of course, what sets up a long bull market for gold during a typical post-bubble contraction. The real price of gold goes up, and that reflects improving profit margins for gold miners, and the gold sector starts to make money when the rest of the world is in a contraction. But the problem is now, is with pressure on the overall stock market, you're getting pressure on gold stocks as well. And this will continue. So the gold stocks will go down with the major market, and again to a point where we will have be able to identify the next buying opportunity. And also in July, August, we noted that on the gold stocks, they were getting really quite overbought, and the gain since November was really good. So we advised taking some money off the table in the gold sector. Yeah, there's an opportunity coming up in the precious metal sector to get repositioned in some good gold stocks.
New York housing prices are plunging. Does that tell us that Vancouver could still see further drops in housing as well?
Oh yeah, that was it. I remember seeing the headline. Here the headline was NYC, New York City housing prices in near free fall. So, and this one, housing prices, I think they're meaning just, regular residential, and we know that for at least a year and a half that the very high-end stuff had more or less gone no bid. So this is important. When you're in as they've been calling it, and we didn't come up with the term, the everything bubble. And our August the 8th piece concluded that this would be followed by the everything collapse. And everything includes real estate prices, from industrial to commercial to residential. And unfortunately, it'll happen. Oh, yeah, also the other classification of real estate, of course, is farmland values. And those have been under pressure for a few years now. So deflation is a remarkable thing, and policymakers and folks are going to learn a lot about it over the next few years.
Bob, thank you so much for chatting with us.
Well, there we did another one, and looking forward to next week's.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. On Twitter, you can find us at House Street. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.